If 4,000 is really the new floor for gold, if you buy it 4,100, 4,200, you're getting a pretty good price. Silver, given the fact that you have more retail investors, speculators involved, is far more volatile. So it couldn't really hold 50. But I think 50 is no longer the resistance that can't be surpassed. It was a massive double top. The market has already shown it can get above 50. We got to almost 55 in silver. And now we've had a huge shakeout and we're barely back below 50. So I think this pullback is a great pullback. If you thought you missed the silver run, and you might have when it was above 50 and off to the races, buy it now.
Peter Schiff, the renowned economist and CEO of Euro-Pacific Capital, has been one of the most consistent advocates for gold and silver, viewing them as the ultimate hedge against the collapse of fiat currency systems. In his recent analysis, Schiff predicts that gold could surge to $5,000 per ounce, and silver could reach $200 per ounce, as the global economy faces what he describes as the final stage of the fiat experiment. He argues that decades of reckless monetary policy, unsustainable government spending, and artificially low interest rates have set the stage for an historic revaluation of precious metals. According to Schiff, the world's central banks have trapped themselves in a cycle of money printing to sustain economic growth, a strategy that will ultimately destroy confidence in paper currencies and send investors rushing toward tangible assets like gold and silver. Schiff highlights that gold's rise is not merely a speculative event, but a rational market response to systemic monetary decay. He points out that inflation remains far more entrenched than policymakers admit, and even if official CPI numbers decline temporarily, the long-term trend of currency debasement continues unabated. Real interest rates remain deeply negative, meaning savers are being punished while asset bubbles expand. In this environment, Schiff believes gold will reprice dramatically to reflect its true value as the only form of money that cannot be printed. A $5,000 gold price, in his view, would not represent overvaluation. It would simply mark the metal's return to equilibrium in a world drowning in paper debt. Now, let's dive into the clips to hear these insights firsthand. Don't forget to like and share. If you find this valuable, your support
got
helps
above
spread the word.
4,000 for the first time, but most of it was kind of skeptical as to why gold was rising, and not a lot of concern being expressed as to the warning that 4,000 gold may portend. Anyway, so on Monday, following this sharp sell-off, gold rallied $120 intraday and closed up about $105 on the day. So made a new high barely from Friday and closed at its all-time record high close. I think we closed around 4,360, something like that. I mean, the highest daily close ever for gold. Silver didn't totally recover, but it still managed a nice day, closing above 4,200. I mean, closing above 52. I'm getting my numbers confused here. Closing above 52. So again, very strong, yet more negativity about gold, trying to scare people out of gold, get people to get rid of their gold or not to buy gold who might have been thinking about it. But today was the topper, because this morning, gold and silver got hammered dollar-wise like I've never seen. So gold at one point was down close to $300 on the lows. I mean, not quite. I mean, maybe down 280-ish, something like that. We got, well, maybe no, 260 might have been about the low. We got just below 4,100 on gold, and we settled at about 4,125. Now, despite this 6.5% decline in the price of gold was still above 4,000. The price that gold closed today would have been a record, and was a record when it got to this price last week. So all we did is crash to the record highs from earlier last week. But I think this is going to do enough damage to the psyche of some potential buyers that they're going to be scared out of this market when it rises to 5,000 and higher. I mean, that's what this type of decline does. Now, with silver, it was even more dramatic. Silver was down about $4 on the low today, closed down about 370, back below 50 at 48.70. So silver wasn't able to hold 50, but gold held 4,000 like a champ. And I really think that when it comes to gold, 4,000 is the new 3,000 because gold's got real serious money buying it. And I think there's enough money to keep gold above 4,000. That doesn't mean it can't trade briefly below it like it did after it topped 3,000. You had, times where gold got a little bit below 3,000, but it was a great buying opportunity. I think the same thing will be the case with gold. If it gets below 4,000, you want to buy it, but you don't want to wait for 4,000. 41.25 is close enough, right? If 4,000 is really the new floor for gold, if you buy it 4,100, 4,200, you're getting a pretty good price. Silver, given the fact that you have more retail investors, speculators involved, is far more volatile. So it couldn't really hold 50. But I think 50 is no longer the resistance that can't be surpassed. It was a massive double top. The market has already shown it can get above 50. We got to almost 55 in silver. And now we've had a huge shakeout and we're barely back below 50. So I think this pullback is a great pullback. If you thought you missed the silver run, and you might have when it was above 50 and off to the races, buy it now. Immediately after you listen to this Schiff Gold market wrap, go get some silver if you haven't already done so. Take advantage of the sell-off. Take advantage of the sell-off in gold too. If you need more gold, I think 4,000 again is around the floor. We're going much, much higher from here. And, bull markets don't end. A lot of people are now singing, the funeral for the gold bull market. Hey, it's over, right? Gold is dead. Long live Bitcoin, whatever. It's over. Bull markets that have been going on for as long as the gold bull market has, they don't end like that. If it really was over, nobody would know. It'd be very quiet. It would happen over time. It would be a slow grind, and nobody would realize that we were making a top, because the markets don't make it that easy. They don't ring a big bell and say, aha, you see this big sharp decline. This means it's over. No, these big declines are meant to scare out the weaker players. As I've said in the past, all of the biggest moves in a bull market are down. So when you get the biggest one-day moves, they're not up, they're down, because you have fear. People are afraid that the bull market is over and they bail. And probably there's no, better measure of the fear than in the gold and silver mining stocks, which were clobbered today.
Silver, Schiff argues, will be the most explosive asset of all. With its dual identity as both an industrial and monetary metal, silver is poised to outperform gold once the bull market gains momentum. Schiff notes that silver's supply situation is even tighter than gold's, as years of underinvestment in mining and surging industrial demand, particularly from solar panels, electric vehicles. Once investors realize that there is far less physical silver available than the paper markets imply, in such a scenario, Schiff believes silver could easily rise to $200 per ounce, representing one of the greatest price accelerations in modern market history. The gold-to-silver ratio plays a central role in Schiff's analysis. Historically, when both metals traded freely as money, the ratio hovered between 15-1 and 20-1. In recent decades, it has fluctuated far higher, often exceeding 80-1, a sign, Schiff says, of extreme undervaluation in silver. As gold moves toward $5,000, a normalization of the ratio to around 25-1 would imply silver prices near $200, perfectly aligning with his forecast. Schiff emphasizes that these numbers are not speculative targets, but mathematically consistent outcomes based on historical precedent and current monetary distortions. He also warns that once investor psychology shifts and confidence in paper assets collapses, the adjustment could happen much faster than most expect.
Gold set a record high yesterday. Today, the GDX is down 14.5% from its record high, with gold making a record high yesterday. The GDXJ is down 15%. from its record high. I mean, we're almost in a bear market, technically, right? 20%. And in fact, all the silver stocks are in bear markets. Even though silver hit a record high last week, they're already in bear markets. They're all down more than 20% from their peaks. And if you look at individual gold stocks, right, there are several gold stocks that are down now 20% from their highs last week. So in a full bear market, just based on this one correction, gold is only down 6.5% from its record high. And all of that happened today, right? That whole thing, that whole decline today. Now, despite that, gold is still up 56% on the year. It is having a phenomenal year. But if you look at where gold stocks are trading now, they have lost all of their gains since gold was at 3,750. So the whole move from 3,750 to 4,125, gold stocks have now gone sideways. And of course, when gold was at 3,750, there were probably a lot of people that thought, well, we're not going to get to 4,000. They'll have a lot of resistance there. Little did they know that gold not only got to 4,000, it almost got to 4,500. And the fact that we've now worked off the overbought condition and we've had such a big pullback in the price of gold, yet we're still above 4,000. That is very constructive. In fact, none of this noise, right? None of the volatility of the last 3 days should even matter to gold mining stocks because they're businesses. When you're buying into a gold mining stock, right, you're buying the income stream. These companies are going to kill it in their earnings. Even with the big sell-off we've just had, gold is sold off to 4,125. Silver's sold off to 48 and change. These prices are much, much higher than they were last quarter. They far exceed any analyst estimates of what the prices were going to be. Their earnings are going to be blowout for Q3. They'll be blowout again for Q4. And look at oil prices at about $56 a barrel. Now, I don't think oil is going to stay this cheap for long. It might get a little cheaper before it takes off. But in the meantime, this is fantastic for these gold mining companies. That's about half their costs, right? Is energy, is oil. And so one of the big problems that the gold mining companies have had has been rising costs. Costs have been rising too fast compared to the price of gold and silver. Well, now the price of gold and silver is skyrocketing and their main cost has actually come down a bit. So this is really going to improve their margins. So the fact that gold and silver stock investors ran for the exit so quickly because gold fell from 5,400 to 5,100, forgetting about the fact, 4,500 to 4,100. I keep confusing gold and silver. And silver's into $50, gold's into 4,000. But we got that big drop, but we're at above 4,100. Think about that. We've just had this huge drop, the biggest, 1 day point drop, probably, dollar drop. I'm sure there were days where gold went down more than this percentage-wise. I haven't researched it. But it's never gone down dollar-wise because, of course, gold has never been this high. So $100, $200 is not as big a deal. And believe me, one of these days, we're going to see a $200 update. It's coming, but it makes sense that the first $200 move was down. In fact, up until yesterday, when gold was up over 100, I had never seen gold up $100 in 1 day. Yesterday was the first time I believe that's ever happened. And it was followed by the first time it's been down more than 200. Look, I do remember at one point it was down a couple hundred in a day, maybe. Back in, I forget, 2015. I remember a day, there may have been a $200 drop. It may have been over 2 days, but not as big as the one today. But of course, it was a much bigger percentage. But all of this is noise, right? This is all about scaring people out of the market. Part of it is just how markets operate, right? Bull markets climb a wall of worry, and they like to shake out the excess baggage. A lot of people get into these markets, traders, they take leverage positions, they're in futures, they use stop orders to limit their losses if the markets reverse. And I bet a lot of people who kind of came late to the party, who put in stops, got stopped out, maybe people who've been in it for a while and who've been moving their stops higher and higher to try to protect their profits, probably got flushed out. Probably very few people expected this big a move this quickly, especially after yesterday's record close and strong gains. Probably a lot of people did not expect this big a collapse on Tuesday. And to me, I think, the mainstream, Wall Street, they probably had to, bring out the big guns to really try to scare people away from the gold market because they saw that gold was getting a lot of media attention, that the public was finally maybe waking up. Bigger investors were now talking about it. And so they needed to scare people away. Oh, look, gold is too volatile. It's not, you don't want to invest in it. It's just a wild commodity. It's got no real value. Who knows it's gonna happen. And so I think, from our perspective, because we want to keep on buying gold. I mean, I'm not anywhere near wanting to sell my gold. And so to me, I love any kind of pullback because it enables more customers to get in at better prices. And, it enables me. I mean, I actually bought another mining stock. I bought into I picked one that was down that I had a smaller position and I used today to add to it. Hey, this is a great, the stock I bought was down more than 20% from its peak. So already technically in a bear market. And I figured, hey, let me buy some. And, if these stocks come down more, I'll buy more, right? I mean, I'm not buying the highs because I've got, pretty large positions already. But if the market is going to start giving away stocks, right, I'm not going to look a gift horse in the mouth.
The coming years are expected to mark the most dramatic revaluation of gold and silver in modern history, as the global financial system reaches its breaking point. Decades of uncontrolled debt creation, currency debasement, and central bank manipulation have hollowed out the foundation of fiat money. The system now stands at a stage where confidence, the only thing keeping it intact, is fading rapidly. Once that trust collapses, the world will rush toward real, tangible value. Gold is projected to surge toward $5,000 per ounce, reclaiming its role as the cornerstone of sound money, while silver, the more volatile and industrially critical counterpart, could explode toward $200 per ounce or even higher. This will not be a gradual climb, but a rapid, almost violent repricing, as paper markets fail to reflect true physical scarcity. As inflation becomes entrenched and central banks lose control of their credibility, investors will increasingly reject fiat currencies and government bonds in favor of hard assets. The US dollar, after decades of dominance, is expected to weaken significantly as global trade shifts toward alternative settlement systems backed by commodities and gold reserves. This shift will not only benefit gold, but ignite a powerful secondary rally in silver, which remains the most under-owned and undervalued monetary metal on the planet. Like this video if you found it insightful, share it with others who need to understand what's coming, and don't forget to subscribe for the latest updates on precious metals and the new monetary era that's already taking shape.